Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 31st episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're titling this one, Now This is a Dull Market. There's not a lot going on out there. I'm Ryan Detrick, Chief Market Strategist with the Carson Group. Sonu, what's your title one more time?
Vice President, Global Macro Strategist.
There we go. Got to get that out there. So
every time.
You love that comma. It's important. We know. We found out the hard way. It's important. So everyone, we're excited to be back. Not a lot's going on in terms of market volatility. That's why, again, we titled the podcast what we did. But so just when we were getting in here, people look at this on the YouTube channel. Thank you for all the listeners that listen to us on wherever you get your favorite podcast. We are now streaming this on our YouTube channel, Carson Group YouTube. You can find it quickly. Sonu does not have his headphones on. Sonu, we just spent about 10 minutes trying to figure it out. We still couldn't figure out why your headphones weren't working. You need some new ones. Technology got us again, didn't it?
These are supposed to be good ones. I mean, I don't know if I'm supposed to mention the brand on this podcast, but sure. So that's what it is. Yeah. That's what I got the mic working, and then the headphones didn't work. Initially, the headphones worked and the mic didn't work. So that's
my head exploded because you could hear us and you couldn't hear us, and then everything was going all over the place. But that's all right. We've got it now, and no headphones for Sonu. So everybody, again, thanks for joining the 31st episode of Carson's Facts versus Feelings. Sonu, like we talked about, we're going to start the conversation, kind of a markets focused conversation. Just how dull really things are. I got some stats on you that are some stats for you that really summarize just nothing's been happening for the past week and a half. Now, probably means it's going to change sooner than later, but we're going to talk about that. Sonu, we're also going to take a look at earnings. You've done some really good work with our friends at Wisdom Tree. Take a look at just how earnings season is looking. Housing was a drag last year. Housing might be a tailwind this year. We're going to take a look at that. And then depending on how much time we have left, we've seen a surge in bankruptcies. We are definitely going to take a look at what that potentially means for the economy and maybe even the stock market. So, Sonu, I'm going to set the table here. Last week, the S&P 500 saw 3 days out of a 5-day week. 3 days, the S&P closed up or down less than 10 basis points. I was like, well, that's pretty boring. I look, Sonu, September 2019 and October 2017 were the last two times we saw a week with 3 different days not move as much as 10 basis points either up or down. Those weren't the worst times to be bullish, so think about that. Then we come in on Monday, yesterday, we're recording this Tuesday. Yesterday, another less than 10 basis point day for the S&P, and it was like the lowest volume day of the year. I mean, so wow. The first question is, why? Why now? Why now? Why in the last week and a half has nothing happened from the market? We are just sitting there underneath that critical 4,200 level. Why do you think it's happening right now like that?
It's also even more interesting because this is earnings season, and you would expect things go up and down during earnings season, obviously, because you're getting new information, the market's digesting that information. But so far, so good. I mean, we'll talk about earnings a little bit. And it's just been a grind. And usually these sort of markets are when, what do they say? There's that aphorism, never short a dull market.
Right.
And when low volatility is good, right? I'm not complaining about low volatility. I mean, we always complain about literally every market outlook, or every time someone says what do you think about markets for the next 6 months? And they think, markets are going to be volatile. Duh. Yeah, obviously markets are going to be volatile. So it's kind of nice to see that, we're not seeing much volatility.
Yeah, we were complaining a year ago. I mean, not we, just the world was complaining a year ago. It's, bear market, historic volatility. Bonds had some of the most volatility they've ever seen. And then now we've got no volatility, and people are kind of bored out of that. I mean, so let's talk about that. I'll just talk a little bit about that 4,200 level. Everyone, if you look at a chart of the S&P 500 back to 2021, 4,200 was support. Then obviously last year, right around now, I guess, we broke through there, and then it's been resistance. And it's Sonu, we're just kind of biding our time. Our base case, we've been overweight equities. We've talked about that a lot on this podcast. If you listen to us, for the last 6 months or so, we think eventually we break above that 4,200 level. I like it because we're just sitting there. just sitting there like a tiger, or a cheetah, just sitting there waiting to pounce. And we're going to need something to get us above it. Sonu, what do you think is the number one or maybe two things it'll take to get some more volatility and maybe some upside volatility to break above 4,200 on the S&P? What'll it take?
I mean, at the risk of sounding like a broken record, I mean, there's obviously the Fed.
Yep.
I mean, you think back. Actually, I'll put it this way: last month we had a lot more volatility, but we had a crisis then, right? With the SVB crisis, and Signature Bank going down, the Fed's coming in, FDIC, Treasury, and obviously the Federal Reserve. Yeah. Now, it seems like everyone's like, okay, that's in the rearview mirror. And literally every day, and markets price that crisis in a sense. It's like, oh my God, we're going to get a recession in, a few months from now, and the Fed's going to cut rates. Fast forward a month where we are today, markets haven't really reduced the probability of a recession, still maybe around 40%, depending on where you look and things like that. But they pushed it out further. They pushed it out another 3 months, right? So now it's not like the second or third quarter where the recession starts. Maybe it's a fourth quarter. So, what does that tell you? That tells you that things have, at least as far as investors are concerned, things are moving in the right direction, in the positive direction, I should say. Right?
No, absolutely.
Which is not to say another shoe won't drop or anything like that. Nobody knows, right? But so far, so good.
Yeah, and definitely check out last week's podcast where we talked about things you don't see in a recession. Just yesterday, Ferrari was making all-time highs again, and Louis Vuitton, the LVMH, I think it's the ticker or the name of the company, but the real expensive European, consumer brands. That was the first $500 billion European stock ever, 500 billion, right? So again, you don't tend to see that in a recession. I do have a couple of quotes here I'd like to use from some of the recent earnings. Jamie Dimon at JP Morgan, it was about a year ago. He talked about the economic, economic hurricane, I think right about a year ago, maybe 13 months ago. We're getting there at the 1 year anniversary of that, but we haven't seen an economic hurricane yet. Now he said it's not looking like a credit crunch right now. And then Brian Moynihan, is that how you pronounce his name at Bank of America?
Brian Moynihan from your old neck of the woods, Charlotte, right?
Yeah, exactly. Yeah, Bank of America, a lot of jobs there. So he had to say this. He said, I always laugh at my own handwriting. It's like, what did I write here? Consumer financial positions remain generally healthy. Now, believe me, you can look at a whole transcript. Maybe there's some caution there, but reality is banking stock so far, Sonu has had some pretty good earnings, good reaction. And then one thing you pointed out last night or this morning, I guess depends when our partners find it or see it, you do a daily note for our more than 300 Carson partners that is truly unbelievable work. And you pointed out some of the buying that's been going on, insider buying. We saw some of the most insider buying last month again being I guess March technically, so this is March, since May of last year, the most buying. And then if you look at most of that, over 1,100 companies, I think, or 1,100 insiders are buying a big amount. More than half of those came from financials, which again was one of the hardest hit groups, a group that we talked on this very podcast. We added some financial exposure to the models we run for our partners when a lot of people are running for the hills, cutting guidance, cutting this, cutting that. Insiders are buying, and we dipped our toe a little in financials. Do you like seeing insiders coming in like that?
Yeah, and as Ryan, as you mentioned, that we also bought financials, but we're not insiders. So. Just qualify.
No. Well, that's a good point. No, we just no, we're not insiders. That is true. Joking. Yeah,
but so yeah, if we were, I guess we would have disclosed it a long time ago. But anyway, getting back, no, it's always a good sign when insiders are buying because presumably they know the most of the about their companies, right? And we're talking about like high level officers, directors, large shareholders, folks like that, right? And look, for the most part, you think about. Jamie Dimon, Sundar Pichais of the world, CEO of Google, a lot of their compensation comes from stock. So they're always selling in a sense, right? Because that's what, they have to turn that stock into cash because they have to, finance their home, multiple homes, whatever it is, right? So insiders are almost always selling. But the nice thing about this study that the Wall Street Journal reported on is that they look at sales outside of that. Right. And that's why it's nice. They always more than the actual number, like, $800 billion sales or 1.3 billion, whatever it is. Right. It's always interesting to see the number of people buying and selling. And that's what, as you mentioned, is a record highest number of officers, directors, folks like that buying stocks, buying their own stocks since last May. I think that's a great sign. I mean, It's positive.
Absolutely. And it actually came from Washington Services, a great Wall
Yes,
Street Journal
that's
article
right.
just recently. But that data from Washington Services, again, some big insider buying relative to what we've been seeing, and a lot of it focused in financials. You mentioned kind of like the idea of broad-based strength, participation, broad-based buying. Let's talk about Europe for a little bit. Recently, we did upgrade our view on developed international. We talked about this on this very podcast to market weight from underweight. I look and I see Europe is doing great this year. France is up like 20%. France is like an all-time high. I mentioned already some of the consumer names in Europe that are doing incredible. You know, boy, I mean, is it justified? I mean, you got France up 20%. A lot of other big countries in Europe up, at least double digits. Remember the U.S. as we record this, S&P's up, call it 8%, give or take. Technology up more, yes. Small caps up less, but overall, Europe's been just crushing it. Is it justified? You think?
What's interesting is that, so let's place that next to EM, right? When you think outside the US, you have your developed markets, which is mostly, Europe, but Japan's a big piece of that. But set aside Japan for a moment, right? We're talking about Europe. And then you have EM, which is obviously a large part China. And I think China's, they just reported GDP. They surprised to the upside, 4.5% year over year. Everyone is expecting 4%. And I think they're well on track to hit their target which is their official target, which is what things normally end up being, the way China's GDP numbers work and all of that. It's going to be 5%, right? Maybe slightly higher even. So things are on track there. But a big part of the rebound is because of consumption, right? Now, at the same time, if you look at EM stocks, they haven't done really well, especially Chinese stocks. They've lagged, right? I think a big part of that is a lot of managers, especially in Europe and the US, probably the US more because we're just so large, right? They are worried about China's political stuff, right? So they don't want to put more money in. But of course, how do you play the fact that Chinese consumption is rebounding? Well, you buy the luxury retailers and things like that in Europe, right? So you just mentioned LVMH. There's Hermes as well, and companies like that. I think did we mention Ferrari last week? Or
we talked about Ferrari. Yeah, my friend, our friend Charlie Bolello pointed some of these things out. The Ferrari's making all-time highs. Do the Chinese buy a lot of Ferraris? I honest to God have no idea. Or are they just it's just more of a way to invest in it. Whatever it is, Ferrari going up, like revving higher, like how I did that, just shows Europe's doing better. Yeah.
No, I think a lot of international portfolio managers are trying to play the China reopening by investing in Europe. I think that's what's happening there. And the dollar, I think, not going up.
What about real fast? Let's go about Chinese retail sales. You might have mentioned it last week, but I don't think you mentioned it so far. Chinese retail sales came in stronger than expected, right? Another sign China is coming back, right?
10.5% to 11%, something like that, up year over year as of March. So that's huge, right? That's much higher than what we've seen. Probably the highest in a couple of years. And I mean, retail sales are growing, goodness, slightly higher, maybe about 12% before the pandemic. And then they've just been like 2020, they were the first to shut down. And then they shut down again 2021 into 2022. It's been a mess there, right? So they've really struggled with it. Whereas the rest of the world is, yes, we shut down. But then in the US, at least, I think safe to say we've had a V-shaped recovery. Right, China's not seen that really, right? But now things are coming back, and I think that's positive for the global economy.
Exactly. We mentioned multiple times on this podcast. Last year, you had the supply chain issues, you had the aggressive Fed, you had inflation, you had China locking down, shutting down, opening up, all those things. Now, a lot of those things, which were headwinds a year ago at this time, are turning into tailwinds. Sonu, the other thing I wanted to point out here is the VIX. You and I get the luxury of working with advisors and their clients every single day, and it's a lot of fun. And we've been hearing more and more about the VIX, at least. I don't know what the VIX did yesterday. I know on Sunday or evening when I looked, VIX was around 17.5. Here's the thing that people talk about. Last year, right, when the VIX would get down to around 20 or 19, that would be it. Volatility would pop. What would happen? The stock market would sell off. The VIX was low, they would tell us, and that was a bearish sign. Well, if you just looked at the last year and a half, the VIX is wildly low, sub 18 right now. But again, talk to me about why we should take a bigger look at the VIX, because maybe 17.5 isn't so low, right?
Yeah, so the VIX is, just to define what exactly the VIX is, the VIX measures implied volatility. So the volatility that's implied in options, right? So why does it go up? That means a lot of people, simply, this is very simply put, people are buying a lot of short-term options. options that expire in a month, right? Probably more put options than call options, but that's what the VIX is measuring, right? So usually when markets go down a lot, you expect the VIX to go up because, like people want suddenly think about, oh, I want to hedge, right? I want to hedge with puts. I don't want to sell my long stock positions. I'll go buy a long put on the stock or the index or whatever it is, right? But the other thing is the VIX going down. Also, we titled the episode with talking about dull markets, right? There's an interesting thing in that some of these aphorisms, a lot of them actually have their did I say what's a way to put it? It basically comes out of what happens in options markets, right? So the thing is, a lot of retail investors, like folks like we, the investors our advisors, talk to, they buy a lot of puts to hedge portfolios. They do covered calls as well. I won't get into what exactly covered calls are. Basically, they are trying to lower their equity exposure because for whatever reason, right? Their equity exposure is 100%. And they want to lower it to maybe 80%. They're like, oh, we don't want to take that much risk, right? But somebody's selling them the stuff, right? Who's on the other side? The dealers, the market makers, they're on the other side of this, which means they are long the market, right? They have, because you can't just make equity exposure disappear. You're just giving that to somebody else. Now, in this case, you're giving that to the dealers, and then dealers say, you know what? We don't want to take directional exposure. We don't want to be exposed in a positive way to equity markets. We just want to make money with, through the bid-ask spread, right, on stocks and things like that. So what do? They hedge that, right? Now, if you have long equity exposure, how do you hedge it? You short stock, right? Now, this is where implied volatility and time actually becomes interesting. As implied volatility drops and as time passes, as you get closer to maturity, that equity exposure that they have to hedge, that starts to compress, that starts to fall. Right? Which means they have to hedge less, which means they have to short less stock, right? So they start covering their shorts. That's why in dull markets, when implied volatility is falling, you see the market sort of grind higher. And that's why they say never short a dull market.
Very, very interesting there. So again, you've maybe heard the VIX, the fear gauge. But bottom line is when you look in history, we've had years where the VIX has been beneath 20. You go back to 1990, everyone. The VIX averaged about 20. Okay. So, the funny thing is it rarely hangs out around 20. You'll have years above 20, which is kind of what we just saw really the last couple of years. And now we might be entering a new regime, right? If the information is changing, maybe we should change our opinion. We're starting to see this lower VIX where maybe it's not as low as you think, because we have seen like single digit VIX. We're not predicting something like that.
Yeah. I think the last
way the
decade
market's
we saw
acted,
like 9 VIX, 10, and like average maybe around 12 or something like that. So there's a lot of room to go even further down.
And that's something I think a lot of people, maybe when you hear the headlines, you think, oh my God, the VIX is sub 18. That's the end of the world, because it's been the end of the world lately. Well, listen, things might be changing, as we've talked on this very podcast before about this new bullish regime we do think we are in, and that low VIX is actually, quote unquote, low VIX is actually somewhat confirming it. The final thing, Sonu, we definitely need to move forward. Last week I talked about some of the negative sentiment, this historic negative sentiment that we are seeing out there, and I wanted to point out the Barron's Big Money poll, because this came out over the weekend, so it's new. This is fascinating. 36%. They interviewed 130 different institutional investors, by the way. It comes out every 6 months. The Barron's Big Money Poll. Big fan of Barron's. Read it every weekend. Been quoted in there before, so thank you to that. 36% bullish from 40% 6 months ago. We've had a big rally in stocks the last 6 months, Sonu, yet less people are bullish. Now, here's what gets really interesting. They asked the 130 institutional investors about their clients. According to them, only 6% of their clients were bullish equities right here. 6%. Wow. And we get to work with advisors every day. I don't know if it's quite that low, but honestly, it's pretty low when you talk to the average person out there on how they feel. Now, here's one that really got me. They asked the people that they're bullish, neutral, and bearish. They asked the bullish group out of the 130, where do they think the S&P will be in a year? These are the bullish people. They said up 1%. So the biggest bulls they could find are looking for up 1% a year from now. Now, trust me.
I'm talking to Ryan Detrick, right?
Well, no, I mean, now believe me, I get it. Sometimes smart money's been right, smart money's been wrong. But the things we've been pointing out really since October. When you see things like that, to me, Sonu, that says one thing. There's a lot of kindling. There's a lot of wood there. Once you start that fire, like that match, maybe it's get above 4,200 for whatever reason. A lot of people don't think the market's going to go higher. We talked about some of the other stats a week ago in the podcast. Listen to that if you want. But laying this on top of those, it's really, I've been doing this over 2 decades. It's a fascinating scenario where there's a lot of positives out there and nobody seems to want to listen to them. I don't know why, but nobody
You
seems to want to
said it
listen to them.
earlier, like when you're talking about China and all that, all those headwinds that we had last year. Last year, I think we had good reason to worry. The Fed was on an aggressive campaign to raise rates, the fastest rate hike since 1980, right? They took it all the way to 450 basis points, 4.5% from near zero. That's cause for concern. China was shut down. That's cause for concern with supply chains. Inflation hit a 40-year high. It's cause for concern. We are in a much better place today.
Right. No,
I don't know what else to say.
Exactly. And you've got very connected bank CEOs saying economic, tsunami, economic hurricane coming. So again, it's where we are, but the good news is we're moving forward with it. So the next thing we want to talk about is earnings. We don't want to spend too much time on this because there's a lot more earnings to come. So we might talk about it next week. But so far, earnings have come in pretty strong, and with some help from our friends at Wisdom Tree. I'm huge fans of Wisdom Tree. Jeremy and the team over there, Professor Siegel joined us recently also with the help of Wisdom Tree on this very podcast. The most listened to podcast we've ever had was one with Professor Siegel. It looked like small caps and mid caps are doing quite well. Something I haven't heard too many people talk about. What are you seeing so far with the help from our friends at Wisdom Tree on earnings this year?
No, they've got this great site where you can go dig into all sorts of things with respect to earnings. And look, about a fifth of the S&P 500 is reported, and they're seeing sales growth, revenue growth of about 7%. Earnings growth, for all 500 stocks, it's expected to be about -6% year over year. So far, it's come in around a little under -1%. So that's positive. But we do have a long way to go we're going to get Microsoft, Apple, Exxon is a big one this coming Friday. But you mentioned small caps, right? So again, condition this on the fact not a lot of small caps have reported yet. It's less than 10%, but they're seeing earnings growth of almost 22%, sales growth of about 7.5%. And Ryan, this. The companies play this game, right? They start to lower guidance, lower expectations so that they can beat, right? So it's almost like your markets are more interested in, which company is surprised to the upside more often than not. And turns out, I was looking at some numbers. So far, S&P 500 companies, the fifth who reported, they've reported earnings 6%, I should say 6 percentage points higher than what was expected. With small cap stocks, so far they've reported earnings almost 9% higher than what was expected, 9 percentage points. So if earnings are expected to be 0, they've come in and said, you know what, actually earnings are 9% higher.
That's great. So, and you think about it, clearly all these earnings matter, but if you're having this big recession, small caps are going to feel it probably more than anybody. That's what we've seen historically in bear markets and recessions. Small caps taking on the chin more than anyone. But we're not, and again, it's very early, right? But it's great data from Wisdom Tree. We'll talk about this, I'm sure, a lot more in the future. But so far, we're not seeing too much worry from small caps. In fact, we're seeing what we'd consider to be more strength. We've seen 2 weeks in a row now, small caps have outperformed large caps. Trust me, they underperformed a lot starting in March with the financial issues that we had. But we still think there's tell me there's a chance, to quote Jim Carrey, we think there's a chance that small caps still can do well. And do not forget this, last point on this. A lot of banks, a lot of financials, a lot of regional banks make up a good portion of small caps. So it's not a shock when those regional banks got hit like they did, the small caps underperform. But we talked about the insider buying and some potential positives we're seeing in financials. Maybe small caps can come back. Anything else to add on earnings, Sonu, before we move forward?
No, I think the big ones are coming, so that will be interesting. Look, at the end of the day, I don't think it'll be, once most of the big tech firms report, I think that earnings growth will probably get closer to what was expected. But still, I think if you look at the beat rates, like the percentage of companies beating expectations, we're pretty much, we're close to the average of the last 5 years and higher than where we were across the last 10 years, right? So that's positive. Like you said, another thing you don't usually see during a recession.
That's true. Final comment on this, coming off the COVID lows. I remember there was one quarter off those COVID lows where like the average stock in the S&P beat by like 20%. They beat earnings by 20. This everyone, rightfully so, was worried. But again, corporate America said another thing, and we had a 2-month recession, but we came out of it quickly. All right, so we've got 2 more things to talk about and about 10 minutes to go. But I do want to take a shift here for a second. I'm a huge Sly Stallone fan, Sylvester Stallone, and I guess I'm late to the party, but I started watching Tulsa King, and it's awesome. I watch it. It's on Paramount Plus. His new show. I heard people. I thought it was amazing. I don't believe you've seen it yet, but I do know I think a fact, because you showed me a picture on Twitter of you in front of Rocky with your arms up. You're a big Sly fan. I'm taking it.
I am a Sly fan, and
Yeah.
it used to be. I mean, it's I haven't seen some of those movies for a long time,
Sure.
but I always go back and watch Rocky. It's my favorite film. It's my favorite movie, Rocky.
Right.
The first one.
Yeah.
I do
The
like
first
the
one?
others too.
Okay.
The first one
Yeah.
is my favorite.
Yeah, I mean, all of them are good. I like 4, I guess, when he fights Dolph Lundgren. Over
4 is,
over
I
there
think,
in
the
Russia.
first one I saw. It starts with those 2 gloves coming together.
Oh man, the music and the explosion, yeah, and then he brings
Eye of the
everyone
Tiger.
together, right? Oh man, yeah, that's we should do a
They're just
montage of you and I
children of the
running to Eye of the
80s
Tiger.
here.
Yeah. Well, anyway, so I'm a big Sly fan growing up, loving that stuff.
Right.
Kind of had to pick, Sly or Arnold. I don't know if you could like them both necessarily. I mean, we did, but we always
I've
had a
always
favorite.
preferred Sly a little bit more. Maybe it's the,
Me too.
like the little lisp he has when he talks, and adds a
Mhm.
little something, and
Yeah.
so
Well, definitely everyone check out, if you like Sly and you like the idea of like a mafia show with a little bit of humor, check out Tulsa King. It gets the Ryan stamp
I'm going
of
to
approval.
check it out.
And you can watch them. And this final thing on this. They're like 37 to 40 minutes. It's not a full hour. There is a little bit of a commercial. If you watch it on Paramount Plus, that's fine. But yeah, it's not like a whole hour, so you can watch them fairly quickly.
Okay.
All right, Sonu, 2 more things to talk about: housing and bankruptcies. Let's start with housing. We've talked a lot about how there was a housing depression, you could say, last year, and the Fed potentially caused it by raising rates as much as they did, just putting a real stop to housing. Literally this morning, I haven't had a chance to look into it, but I think 8 straight months of Case-Shiller prices going down. It's housing prices going down. Just this morning, I saw headlines. They did tick up a little bit, but housing is clearly been a detriment to GDP. Last thing, I'll turn it over to you. The work you've done for our Carson Partners, you pointed out 2.1% GDP growth last year, nearly 1% how do I put this? Housing took away nearly 1%. So it could have been over 3% of housing was just even. But housing is only like 5 or 6% of GDP, but it was so negative. It really was a headwind. But now, just maybe, we're seeing some positives, and housing can be a tailwind I don't think anyone's talking about. Take it away, Sonu.
No, housing's been a drag. So when you talk about housing in GDP, we're talking about like residential investment. Like you said, it's about 5%, slightly under of GDP, right? But it matters because it's so volatile. It can be, like we saw last year, right? So like even in your portfolio volatility comes from maybe a few stocks. It doesn't come from everything in there, because most stocks are, have average volatility. But if you have 1 or 2 that are flying around the place all the time, that's going to dominate, right? Same thing within GDP. Housing, is very cyclical. That's why we keep an eye on housing, right? Housing usually leads, dare I say, the economy into a recession, because the Fed raises rates, housing goes down, boom, recession. Housing's also the first one to lead an economy out of a recession, because prices go down, rates are down, affordability increases, and then it comes back, right? But housing's been a drag on GDP for, get this, Ryan, 7 straight quarters, right?
Whew.
Q1, we're going to get the GDP data later this week, but it'll probably be the 8th straight quarter where housing's been a drag, but I think it's ending right now. So residential investment, housing and GDP, the 3 big pieces, right? One is construction, mostly single family construction. That just tanked last year. It makes up about 40% of residential investment. That was down about, 23, 25%. That's massive, right? And any housing chart, starts, permits, things like that, you look at it, it's like a little crash, right? And then about a third of residential investment is home improvements, right? You remember last year, there was, last couple of years, there was a lot of that, or especially 2020, 2021, people are stuck in their homes. You're buying a lot, let me redo my kitchen, let me redo my bathroom, and, supplies are hard to get. So that contributed in 2020 a lot, and same thing into 2021. But last year, there was a little more of a drag of that because, people are done with all the home improvements, I guess. brokers' commissions, right? That is a big one, right? It makes about a fifth of residential investment that just crashed because guess what? Nobody is buying homes, right? So brokers are not making money, and titling fees and all of that, right, is included into that. So what's good right now, what's positive is we're seeing a turnaround. Existing home sales pulled back a little bit in March, but it's up about 10%. 10% in the first quarter. And this
I'll jump in just for a second. Let me just jump in just for a second. According to your notes that you sent out to our partners just last week, existing homes were down 34% last year, 2022, but up 10% so far this year. So still a ways to go, but the bleeding has stopped.
And what's interesting is it's not like affordability has gone down, right? Like rates are still, I mean, it's not 7% like last November. It's 6.5%.
Yeah.
Still high. Of course, not as high. This is in the ballpark of what a lot of us were maybe paying in the 2000s, but it's definitely much higher than what we were paying, 2-3 years ago, right? So monthly payments using the median price of a home at a 6.5% mortgage rate and assuming a 20% down payment, it's about $1,900 per month, right?
Yeah.
That's double of what it was 2 years ago. Can you believe that? So affordability is, I was going to say a term which I shouldn't use, so I won't say it. But affordability just crashed, right? But like I said, homes have rebounded. There's massive pent-up demand. You think about the millennials, right? It's a large cohort, right? Especially folks between 25 to 34 years. That's prime home buying age, right? That's when people get married. They, they want to start a family. They want to buy a home, right? Problem is there aren't many homes for sale. And that gets to the problem. Right. A lot of us have our mortgages at about 3%. You're not going to sell a home and go take a 6.5% mortgage. No, right? So a lot of these new buyers or potential buyers are being pushed into the new home sales market, Ryan. That's what's happening. And guess who that's good for? Builders, right? And the thing is, builders are giving so many incentives these days. Like this effectively that 6.5% rate becomes something like a 5.5 or 5% rate. They think, okay, these folks can refinance later down the line when rates go down. But for now, we just got DR Horton's earnings the other day, and they said, supply is limited both for new and existing homes, and demographics are supporting housing demand, right? So I think housing starts, which are, like stuff that they're just starting to put the foundation on, that's also rebounding, right? So builder confidence is up about 7% over the last few months.
Yeah.
So I think housing should be at best going forward for, let's say, the next 3 quarters. I don't think housing will be a drag, but ideally, if starts start to push up, we start seeing construction increase, we start seeing more sales activity, it'll be a positive force on GDP, right? And that's the irony of it. Like normally this is towards the end of a recession is when we see the sort of, these sort of housing dynamics. But now everyone's talking about a recession. Like you and I talked about this the other day. Everyone talks about the economy right now as if it's like late cycle. And I'm not saying it is or it isn't. But just looking at housing, it feels like, wait, we're really early in the cycle, right? I'm not saying we're not. We're early in the cycle, but it feels like that if you look at the housing data.
Exactly. And continuing, I guess, to last week's podcast, things you don't see in a recession is housing, starting to bottom and go higher. Usually, it's not necessarily what you see. Now, I will say DR Horton, just to add a little more, the stock was up 6%. I think it was on Thursday, but late last week, reaction positive. Earnings came in $2.73 expected. They beat by 81 cents, and revenue was nearly $8 billion. That was almost $1.5 billion more than expected. One final comment, they said they expected to see between 77 and 80,000 homes made in 2023, and earlier expectations were for 71,000. So it's a pretty good sized beat. And again, are you really going to have a recession when housing stocks are literally like doubling what the S&P's done for the year, and even since last September, October, even like tripling, I think, what the S&P's done. So with housing leading, housing stocks leading, I'm sorry, I should say, that doesn't feel very recessionary either. All right, Sonu, the final thing that we wanted to talk about, because we've heard a lot about it, is bankruptcies. Now, I'll be very honest here. There have been some high-profile bankruptcies. One of them was Bed Bath & Beyond. Honest to goodness, I thought they'd already declared bankruptcy 4 times. So
Maybe you're
that
thinking
surprised
about
me.
linens and
I
things
don't
or something. They all seem to merge
don't
into
know.
one, right?
I don't know. I don't. Now, this is nothing against any of these companies in particular. I don't like going to these stores. I don't like shopping. I hate parking lots because people are idiots in parking lots. So anyway, but I was surprised. So Bed Bath Beyond officially declared for bankruptcy, but I swear I've heard that before. Nonetheless, so it's not funny because we are seeing a huge spike. Not huge. We're seeing a significant spike, Sonu, in bankruptcies. And you took a look into some of this stuff because we've had this very question come from some of our partners. Like, look at this. Is this the canary in the coal mine? We're seeing some legitimate large companies that we know and love and use declaring bankruptcy. And since December, we've seen a big pickup in the number of bankruptcies we've seen. How worried should we be?
It's always concerning when the bankruptcies are picking up. And of course, and last month we had a big one with a couple of big ones with SVB and Signature Bank, right? So speaking of chapters,
and Sealy, they make mattresses. I know Sealy was one of the other big ones that declared bankruptcy recently as well.
And usually when you're thinking about bankruptcies, you think, okay, what's the next step? We should be worried about, or why should we be worried about it, especially as investors? Like, oh, they may default on their debt, right? So that's when you go hunting around for the data and you look at, okay, let's look at the bond market and seeing what bond investors are pricing defaults at, right? Especially if you look at the high yield bond market, which is, companies that are usually have to pay more interest to borrow money because, there's a higher likelihood that they default. Right now, if you look at those spreads, so the spread between the interest rate these companies pay versus US Treasury yields, right? Those spreads are not signaling anything that's concerning, right? High yield spreads, especially if you take the last 20, 25 years of data, it's about the 43rd percentile. In fact, from an investing standpoint, I hear a lot of people saying, well, it's not very attractive, right? Why do they say that? Because, spreads are tighter, right? Markets are not very concerned. Usually spreads are like 85th percentile. You think, oh, the markets are worried about, rising defaults, things like that. But then that's when investors, the contrarians come in and say, you know what, that's a good place to buy because it's cheap. It's valued, very cheaply, right? So that's what I would say with respect to bankruptcies. You have to go look at the bond market. It's a very liquid market over there. High yield spreads are not signaling anything that looks like a problem, at least not now. I'm not saying it could not happen in the future or anything. Right now, they're not, right? And then, Ryan, if you look at the other side of bankruptcies, this was interesting because, the more I thought about it, I was like, okay, bankruptcies signal a company going out of business, right? So let's look at companies that are just starting out, new businesses, right? So entrepreneurship actually took a huge spike up after the pandemic. A lot of people started their own companies and things like that, new opportunities. But the nice thing is, so those measure in the hundreds of thousands, right? But the Census Bureau also looks at IRS data because, businesses, especially those likely to turn payroll, have to file certain forms. And so they call them like high propensity businesses likely to turn a wage, right? That's just how it's defined. Those businesses are, the number of those businesses are up 2% year over year in the first quarter, right? And it's 23% higher than it was in the first quarter of 2019, right? 23% higher. New businesses that are likely to turn payroll, right? Or already have declared their first payroll, right? That's huge. I mean, you look at that and you think, wait a minute, you put bankruptcies against this and, things don't look horrible. Once again.
Yeah, I've called it denominator blindness before. You talk about all the debt that's out there. There's also a lot of equity out there. Yes, there's some high-profile bankruptcies taking place, and I did look at my notes. Serta and Party City. I've gone to Party City many times to get those balloons filled up for a kid's birthday party. I guess they filed bankruptcy recently. Then obviously Bed Bath Beyond just did as well. According to my notes, 111 bankruptcies in January and February. That's the highest to start a year since 2011, and 151 bankruptcies if you include December, January, and February. Again, a big surge, but it feels like a broken record. We've said before, the credit markets are the smartest guys in the room normally. One of the reasons in the middle of March, we added some equity exposure when a lot of other places weren't. We talked about this on this very podcast. We said credit markets aren't freaking out. Stress, yes, but major freak out, no. And we're just still simply not seeing that. And we will talk about it every week if we have to until we start to see major signs of stress in the credit markets. Then we'll start to get more worried about equities. But for now, S&P is hanging out beneath 4,200. We think it'll pop above eventually, and the credit markets potentially could be suggesting that. Sonu, we've hit the end of the road. I know, obviously, we've got sell and may go away. We're going to talk about that a lot next week. We also have a Fed meeting. We're in the Fed quiet period. Maybe the answer to this is the market's not volatile because it's a Fed quiet period, so you don't get every single Fed governor and chairperson and chairwoman and whatever all these different Fed people are spouting off and causing the volatility. So I love it when you have to put some tape on their mouth, so to speak, and make the Fed be quiet. But what else are you watching as we head into Fed potentially the last Fed hike coming up next week? What else are we watching this week here?
To be honest, like 2 weeks ago or even 3 weeks ago, I would have said maybe they wouldn't raise rates, but it looks like markets are pricing in a high probability, maybe 85% chance of them raising rates one more time, about 25 basis points, so which will take them above the 5% mark, right? I think what I'm really looking for is, I think they stick with the story that they're not going to cut rates this year, right? They don't see cuts. Markets are pricing that in. Something's got to give there, right? Either markets go up and they say, okay, we believe you're not going to cut rates, or the Fed goes, where markets are and guide rates lower in a sense, right? I don't think they'll do that, but that's what I'm watching.
Okay, that makes sense. We'll definitely talk a lot more about those things as we get into it. But with that, we are going to wrap up the 31st episode of Carson's Facts versus Feelings with Ryan and Sonu. We appreciate everyone listening. It's been an interesting time. I'll just say this: my mom passed away about a week ago. So it's been an interesting week. We saw it coming. She battled breast cancer for more than 7 years.
I must say, I loved, I read that the obituary sent me a couple of times, and that was just beautiful. So she sounds like an amazing lady.
Thank you. I did. Mom was awesome. I shared that on LinkedIn if you follow me on LinkedIn or not. But it was we saw it coming because she had breast cancer for 7 years, and my family's a little twisted like this. I joke with her every Mother's Day. Is this your last Mother's Day? And she lived a lot longer, a lot more Mother's Days than we ever expected. So love you, Mom. Miss you, obviously. But I've had a lot of people reach out and give some nice comments and things. So that helps. So just getting on this podcast and doing this is nice to get a little more back to normal. So everybody, if you've got a mom or a dad or somebody, give them a call because you never know what's going to happen. So do that for me. Give them a call and tell me you love them. So with all that, Sonu, this was fun. 31st episode in the books. We will see everyone next week. And we'll talk a little sell and may go away and earnings and whatever else is happening out there. We'll see everyone then. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.